Hello guys. Yeah. Hello guys. How are you doing? This is TLP here, and I'll be your host and your tutor and your mentor for today's class. Okay, today I'll be teaching on market structure. Everything you need to know about market structure, and I'll be very fast with this class, so it won't take time. I wouldn't like it to take time. So just I'll be fast. So you can just always come back and replay the video. Tell me if you download the video and make sure to subscribe. Thank you. So now, market structure. What is market structure? Market structure is simply what you see in the market, because the markets most of the time will look something. The market most of the time will look something like the market is full of ups and downs, ups and downs, ups and downs, ups and downs, ups and downs. So now, market structure is simply what you see in the market. It's simply what you see in the market. So now, the market will usually consists of four stages. We have the accumulation. Accumulation is just like a consolidation. A consolidation. What is a consolidation? A consolidation is just a sideways movement. It's just a sideways movement because they are what are called trends. So trends, there are three types of trends at every point in time. The market is in three types of trends. We have the uptrend, whereby the market is going up and forming higher highs. This is an uptrend where it's forming higher highs and higher lows. I'll explain that in a bit. Then we have the downtrend, where the market is forming lower highs and lower lows. Then we have the consolidation, which is just a sideways movement without a defined direction, where the market is just moving up and down with no direction whatsoever, just moving up and down. So the uptrend is consists of when the market is having higher highs and higher lows. Now, what do I mean by higher highs and higher lows? Sorry, sorry. Yeah. So this is a high, this is a low, this is a high, and lows. So lows are the under of the trend. Then the highs, just by the name you should already know. So what I mean by high highs and high lows is that the next high after the previous high, the next high is higher than the previous high. The next high is higher than the previous high, and the next high is higher than the previous high. Then you see the next low is higher than the previous low, and the next one is higher than this. So that's what I mean by higher highs and higher lows. That's what I mean by higher highs and higher lows. Sorry, let me delete this. Alright. So what I mean by, then for a downtrend, we have lower lows, lower lows, and lower highs. You can see this high is lower than this high. Then this high is lower than this. So in a downtrend, the next high is lower than the previous highs, and the lows are lower. Then for a consolidation, there is no defined direction. The market doesn't have a defined direction that is moving in. There is no defined direction. So that's it. That's it. There's not much. So these are trends. This wait, let me write that down. This is the uptrend. Yeah, this is the downtrend, and this a consolidation, sorry, consolidation. Yeah. So that's it. It about trends. So now, at every point in time, the market is in four four stages. Yeah, we have the accumulation. I won't be writing this down, so you guys should just take notes. The accumulation is a consolidation that leads to a volatile break to the upside. What I mean by volatile is that it has strength, a very strong move, very strong break to the upside. So now that's upward trend. This is your this now is your accumulation. Let me off that. Yeah, this is your accumulation. Then this is your accumulation. The accumulation is the volatile break to the upside. Then the advancement, the breakout to the upside is called the advancement. The advancement is an uptrend. As you can notice, it is an uptrend. That's after that break. Sorry. After the break here to the upside, the uptrend is called the advancement. So now we have, let me delete this. Okay. So after was wrong. So after the advancement, we have the distribution. The distribution is a consolidation that leads to a volatile breakout to the downside. So the distribution, is that distribution? Yeah, yeah. So the distribution leads to a volatile break to the downside. So the distribution leads to a downtrend. So we have the accumulation, the advancement, the distribution, and the declinement or the downtrend. This is an uptrend. So that's market stages. That the I told you that every point in time the market consists of four stages. So now we have break of structures, and change of character. The reason why I'm teaching this is that later I'll be uploading a video on other blocks when points of interest. So you will need the market structure to be able to know what I'm saying, so you won't be confused. So let's say, for example, the market is in an uptrend. Is an uptrend consisting of higher highs and higher lows. Is an uptrend, right? So now, what is a break of structure? A break of structure is the break of the previous high. There is nothing much to it. It's the break of a previous high, and it can be abbreviated as BOS. So this is a break of structure. It is a break of structure. This is a break of structure. It's just the break of the previous high. And in an uptrend, the lows are protected. These are the lows. These are the lows. These are the lows. The lows are protected. What I mean by protected is that we do not expect the break of the low. In an uptrend, we don't expect the break of the low, so they are protected. While the highs are targeted. The highs are targeted. So when you enter on an uptrend, your targets are the highs. The highs. So the highs are targeted. The highs they are targeted. So as I was saying, the break of structure is the break of the previous high. So now what is a change of character? A change of character. A change of character is simply the break of a previous high or low, depending. So in an uptrend, this is what is called a change of character or a shift in market structure. I usually tell my own a shift in market structure. Then subsequent breaks are break of structures. So this now is a break of structure. I hope you understand this. This now is a break of structure. Now in a downtrend, the lows are targeted and the highs are protected. The highs are protected. This is called protected levels, protected and targeted levels. Um. So then, if at any point in time the market also breaks a low, it's called a change of character or a shift in market structure. These are what market. This is what the market does. This is called a shift. And now this here is called a liquidity sweep. I'll be doing that later. It's called a liquidity sweep. You won't understand, but let's just move on. So once again, the lows are protected and the highs are targeted. This is a break of structure. I hope you understood that. So that's literally all to break of structures and changing market structure. So I'm done with this video. Let me give you an additional knowledge. So now we have fake break of structures and fake change of characters. And to see that, we have to look into structure and substructure. So now we have what is called time frames. What is called time frames. So in a time frame, for example, right now we are on the 15-minute time frame. You can see in the trading view app it consists of candles. So in the 15-minute time frame, it means that each candle you see here consists of 15 minutes of price movement. So this here is the movement that happened in 15 minutes. The next candle is the movement of 15 minutes. That's it. So when you're in the 4 hour time frame, this is the time frame section here. This is for time frames. So when you're, for example, now we're in the 2 hours, it means that every candle you see here consists of 2 hours. This is what happened in 2 hours. Understand this. It's what happened in 2 hours. 2 hours of price movement or price action. Price action just simply means price movement. There's nothing much to it. So now in the 4 hour time frame, we have the higher time frame and lower time frame. The higher time frames are the 4 hour, the 1 day. 1 day, every candle consists of 1 day of price movements. Then we have the 2 hours, the 1 hour. Then the lower time frame, we have the 30 minutes, 45 minutes, 15 minutes, 5 minutes time frame. Me, I usually don't go below the 15 minutes. So now we use the higher time frame, the daily and the 4 hour time frame to find the market structure. Then we use the 1 hour, 30 minutes, and 15 minutes to find an entry. So now, in the 4 hour, every candle you see in the 4 hour. Sorry, I'm very sorry. Sorry, let me off this. So every candle you see on the 4 hour consists of two candles in the 2 hour. Ah, God. So every candle, one candle in the 4 hour is two candles. Is two candles in the 2 hour. Is two candles in the 2 hour and four candles in the 1 hour. Then I think eight candles in the 30 minutes. So in one candle in the 30 minutes time frame is two candles in the 15 minutes. So it's just like a division something. So now what I mean by structure and substructure is that one candle, let's say for example that this is the 4 hour time frame. This is the 4 hour time frame. One candle in the 4 hour time frame in the 15 minutes, let's say this is a green candle. It can consist of this, something like this in the 15 minutes. One candle. So now the higher time frame is called the structure and the lower time frame is the substructure. So now what I mean is, let's say for example the higher time frame is in an uptrend, as in an uptrend like this. Yeah, let me make this bolder. This is the higher time frame in an uptrend. You notice that, let's say for example that this one now is the daily time frame, and as you can see it's an uptrend. You will see that if you go down to the 30 minutes time frame, the 30 minutes time frame will look some sort of this, consisting of uptrends and downtrends. Can see a shift in market structure here, a break of structure, then another shift. You see that this is how the lower time frame will look like. This is how lower time frame will look like. So the lower time frame delivers price to the higher time frame. Get this into your score. So now what I mean by fake change of characters and break of structures is something like this. This now is a shift, right? But is a fake shift because it does not align with the higher time frame. So when before you can consider a trend to be over, you have to look at the higher time frame. So you can see that actually the protected levels have not been broken. It hasn't been broken. But in the lower time frame, it looks as if the trend is over. So you should know this. You should know this and know peace. You should know this. What the lower time frame is doing is looking for a point of interest down here to mitigate before delivering price to before sponsoring the next break. Before sponsoring the next break. So that's it. So that should be all on market structure. It would be good if you guys download this video and make sure you go and watch it. I'll be uploading the next video on points of interest very soon. And make sure to subscribe. Make sure to subscribe. Have a nice day, guys.